It says host disabled participant
Yep,
screen sharing.
I
Is there any
got
way you can
you.
turn that on for me?
Yep. All right, here you go. And let's
Okay.
go. So, okay, guys, it's Bill Feggins at Bill Feggins Academy. We're going over the the FFIUL II with Transamerica, and we have Jason Gillapple in here, and you guys will meet more of Jason, because I know he can help you out with everything. So, I just want to say thank you, Jason, for jumping on here. I know Scott couldn't get on here because he's under the weather, but we really appreciate you, and I'll let you take it from here.
All right. So thank you guys so much for having me today. So we just recently made some changes to both of our Index Universal Life products, but the most common one and the one that we sell the most of is our Financial Choice Index, or sorry, Financial Foundation Index Universal Life, because this product is really designed for most um, client bases. So whether you have like a juvenile, we do a lot of juvenile policies on this, small business owners, people really just looking to supplement their retirement income, in another way. Like if they don't have access to like 401ks and stuff, this is a good resource for them. And can you all see my screen here?
Yes, I see it.
So
Yes, we can
the
see it.
more to love thing here. Okay. All right. So a few weeks ago, we made some changes to our Financial Foundation Index Universal Life. Most of the key changes revolve around indexing rates. So we enhanced our cap rates, and we added 2 additional accounts. So there's a lot more versatility and flexibility within this product now. So previously, we had a global index, an S&P 500, and we had a basic interest account. So that's still the case, but the global index moved from a 13% cap rate to a 13.25% cap rate. So we increased the cap by 0.25. Our S&P 500 account was 12%. Now it's 12.25, so another 0.25 there. We added a basic S&P 500 index account that has a 9% cap rate, but it doesn't have index account monthly charges on it. So there's no monthly charge fees associated with it, but it does have a lower cap because of that. But the big thing that we added is an uncapped balanced indexed account. And, so the upside potential is kind of unlimited on that. But across all of them, we have a 0.75 floor rate. Most other carriers are going to give you either a 0 floor or 0.25 floor. With us, you're getting a 0.75 floor, which means you're going to earn more in those down market years. So when the market's negative, they're still running at a 0.75 positive rate. And so some changes we did make within the global index. So as you can see here, so the global index has basically 3 different buckets. It's got the S&P 500, which compromises 50% of our global index account. We have the Euro Stocks 50, which on this model, it shows 30%. And then we used to have the Hang Seng Index, which was the Chinese market. We moved it to the Nikkei 225, which is a little less volatile. It's more consistent. So the growth potential here is better. So that's a huge benefit. What I will say about the S&P versus the Euro Stocks 50, whatever's performing better out of those two is actually what dumps into this 50% bucket. So we're trying to maximize the growth in that. The 20% will always be that Nikkei 225. Balanced on cap account, same thing. It's 34% is the S&P 500. That stays. That doesn't change. 33% is the Nikkei 225. And then 30%, we have a Fidelity small mid multi-factor index that we use. But one of the key features of this is now there's a 113% participation rate. So you have the potential to earn even more money within that balanced uncapped account. But like I said, they all have a 0.75 floor rate. And so when you look at the last 20-year look back on each one of these accounts, so this is the global index. If you didn't have a cap and a floor rate, the 20-year average in the global index is 6.36%. Applying a cap and a floor rate, we average 8.28%. So this is where our product would have averaged over the last 20 years on the global index. If you go to the S&P 500, average 7.71 without a cap and a floor rate, averages 8.31 with the cap and a floor rate. So you're getting, upside protection. This new basic S&P account, like I said, there's no fees associated with it, but the average index is 7.71, but with the cap and the floor, it's 6.41 on this one, just because you have just lower cap rates. So on this particular product, like these down years are going to play more of effect on this number. But if you have returns like the last few years where you've hit mostly cap rates, over time, this will look better. But once again, we get to this balanced uncapped account. Average index over 20 years, 6.16. With our cap and, well, not with our cap, with the uncapped and with the floor rate, we're averaging 10.46 over the last 20 years. So there's such great upside potential for earning potential with your clients on this. When you are doing an application, just so you guys are aware, the application and the software default 100% to the global index. So from an illustration standpoint, that's not really a big deal because the maximum illustrated rate that we can run at is 7.25. So it doesn't matter if you're in the global, the S&P, or the uncapped, it's the max illustrated rate is 7.25%. But when you're submitting those applications, make sure that you've had a conversation with your clients about where they want to kind of place that money into those different indexed accounts. So this is really the biggest, addition and enhancement that we made. We've had a lot of agent feedback about wanting to have an uncapped account because we know a lot of our competitors in the market, also, do have uncapped accounts. So this is a big deal for us moving forward. Just so you know, like our Financial Choice Index Universal Life, same thing. We increased options, and we also added the same balanced uncapped account to that as well. One of the key things that is with our term and our index universal life products is that we have high non-medical limits for underwriting. So the big picture is if you have somebody 18 to 45, you can write up to a $2 million face amount and qualify for no paramed exams. So no blood, no urine, no doctors, no nurse. Age 46 to 55, you can write up to $1 million and qualify for no paramed exam. Saying that, it's not simplified issue. So if there's a red flag either on the application through the medical questions or something comes up, obviously through MIB or prescription check, we can always request a paramed. I think that they do try to, just ask additional questions as opposed to jumping right to the paramed portion of it, to try to get these applications done faster. I know that the future of Transamerica, they are trying to move to more instant decision options for agents, but the IUL I know is a little bit farther off. We just launched our final expense, which as an instant decision. Term will probably be next, followed by IUL, but like I said, that's in our future. But as of right now, we do just try to have like these high non-med limits for most clients that they should fall into. On the quoting side of it, so we launched new quoting software about a year ago. All of our quoting software can be used for term, it can be used for index universal life, whole life, or our immediate solutions final expense. And so I'll kind of run a quick demo on this because I know that this is what we get the most calls on, agents calling in and unable to kind of figure out the software and everything. And I do think this software is better. It enables more versatility and solves over our last one. Our last one seemed a little more user friendly, but like I said, there are some great upsides to this new one. So I'll kind of get into that. So when you log in at your agent portal, it should look something like this. If you haven't, for have new agents on the line, you should be logging in at secure.transamerica.com. And you should get a welcome page that's similar to this. You guys will actually have more features than I will because you guys are agents in the field. So there'll be like an additional box here that says like iGo eApp. Our new final expense product, Transamerica FE Express Solutions, will also appear here as its own box as well. But Life Illustrators, our quoting software. Other key aspects of this website is Transamerica Life Access. This is where you would check on all your pending and in-force business would be in here. Our old websites, Agent Net Info or Transact, these are, I think most of you guys will fall to the Agent Net Info side. This is where you could still check commissions. Eventually, I think they will get that moved over to here, and these will go away at some point because this website is replacing these down here. But product information, training videos, agent guides, consumer guides, you can find all that here in Insurance Central. But I'm going to start here with the Life Illustrator because, like I said, this is our quoting software. You have the ability to either launch or download. Download is if you want to just have the software on your computer. So if you're out in the field, you don't have access to internet, you can still run quotes and you can have the software on your computer. If you have internet access, you can just do a launch. Our system, when you log into it, it defaults to the Financial Foundation IUL II. So like this confuses a lot of people. Like if they're trying to quote term, like how do I quote term? Well, you'll go up here and change. Now, depending on your screen size, just so you guys are aware, this will look different. If you're on a smaller screen, this isn't here. It'll stay product and concept, but you'll see like a menu button, and then you'll see like a blue like right arrow key, which gets you through these different fields, but it's just on a smaller screen. So just this part of your computers might look different, just so you're aware. And when we were doing training on this, they didn't let us know that. So we were getting frustrated with agents like, why don't you see what I see? So if you're on a smaller screen, this does look different over here. So we're just going to do just like a mock customer here. We're already on the right product, but if you needed to change, you can change to any of our products as long as they're available in the specific state that you're working in. So revise the illustration policy number. This is only important if you've submitted something and maybe you didn't, because not every agent submits an illustration right with the application. Sometimes they'll submit an application to see if they can get an approval. Once you have an approval, depending on risk class, and where you can go back later and create the illustration. If you're doing that after the fact, do select it as revised illustration. You can put your policy number in here, but if you're just doing this to start, this is not an important feature. So we'll just leave it state of Iowa. You can put your client name in here. I'm just going to leave this as valued client for now. If you needed to backdate an illustration, you could do that for save age. So if you're trying to get a lower insurance rate, you can do that. We can, input a date of birth of, let's do tax day of 1990. Let's do that. So 34-year-old male. So here we have different risk classes. So preferred elite, height, weight, good, like no medications, preferred plus, a lot of these have to do with like cholesterol, blood pressure, things like that. The healthier you are, the farther up the scale you come. Non-tobacco, if you select non-tobacco, it does open up if you have people that are table rated, which is very common. Same way with tobacco, same thing, table ratings. We'll just leave this, we'll just do like a preferred. So we won't do top, but we'll just do a preferred rate. Flat extras. If you're not familiar with flat extras, these can come into a couple different arenas. One, if somebody has poor driving habits, DUIs, reckless, like just, a lot of tickets, a lot of times we'll add a flat extra. Where this is most common is dangerous hobbies or dangerous jobs. So if they have a high risk job, a lot of times there'll be a flat extra attached to that. If you suspect that might be the case, you can always reach out to us in the sales department. We can get you with risk assessment and they can tell you, hey, it's going to be like a $2 flat extra, based on that information. But like I said, it's mostly job and driving related issues is what we see the most of. So once you have your client information, you'll go to policy design. And so this is kind of the meat and potatoes of what most of you guys will get into. So you have two different tests, and these are obviously tests that the IRS does um, on index universal life to make sure that they are life insurance policies. You have a guideline premium test and a cash value accumulation test. So the best thing that I can recommend here, if you're dealing in a smaller face amount, generally below 100, 150, you're probably better off doing a cash value accumulation test because it's going to help build the cash early in the policy, especially if they are older and they, like somebody that's, say, above 50 to 55, and you're trying to get as much policy in cash value early so that it'll start to fund itself. You want to do a cash value accumulation test. Guideline is great for long term. So if you've got somebody younger or somebody that really wants to be into this long term and use this for retirement later, guideline generally works better over the long term. But if you're trying to build cash in the short term, cash value accumulation does work better. So we'll just do a cash value one here. Now you have different options when it comes to death benefit options. The most common is level or increasing. We don't ever use graded much, but it does level out a death benefit at a certain point. So, we do have some agents that use graded, but we have this optimal switch feature that's part of this new software. So when selecting optimal switch, our system will determine what's going to be better for cash growth, whether it's doing level from the beginning or increasing. If it selects increasing, what it's going to tell you is, we recommend doing increasing for the first 20 policy years and then switching to level. So it'll run the illustration that way, but it is still up to the client at that 20-year mark to move it from increasing to level. So the system will illustrate it, but it's still up to the client to make those changes. So any kind of policy changes, you're going to want the client is kind of on the hook for making sure that those changes happen. So I'm going to do an optimal switch here. Our most common face amounts are generally between 100 and 200,000. So I'm just going to do a 150 here. So we have different solves. And just so you know, like if you don't have a specific face amount in mind, but like a monthly budget, you can control basically all aspects of this illustration. You can put in a face amount, and actually let's run it that way. So solve will basically just take whatever their monthly budget is. So this seems to be the most common route is people want to spend $200 a month or $250, whatever that number is. And, they're like, if I want to max fund at $200 a month, what's the smallest face amount that I can get to do that? So then you would do a minimum non-MEC. Target is just what target generally gets you guys paid the most as far as, because you guys get paid on your target premium. So what it does is it finds the highest face amount that it can at $200 a month. So out of these solves, target gets you paid the most. This is going to build them the most cash value. So a lot of times you might want to find like a balance between these two numbers. So you can run it both ways, like outside of the client, just to see, which option makes sense. So like a target solve, we'll run it as target first, and then I'll show you what minimum non-MEC does. But if somebody wants to do a lump sum, you can put that in here. If they have a 1035 exchange, you can also do that. With this, there's this little calendar off to the side. So if like this particular person, if they were doing a 34-year-old, I believe. So if, let's say they only want to pay to age 65, so $200 premium from one. So this is from first policy year through max. So basically this is just saying they're going to pay $200 forever. But if I wanted to change this to a 65, it's going to show the premium shutting off at age 65. I'm actually going to run this to 70, but just because the trend is most people are probably not going to retire at age 65. But so I'll run it to age 70, but you do have the flexibility of changing that. Some people maybe just want to pay in for 10 years, 15 years. You can do that. The other thing that you can do, let's say this individual wanted to pay $200 a month for 10 years. So I could do $200 a month from 1 through year 10. So I could just put 10 here. And then I can show an increasing of like $300 a month from year 11 through age 70 or through max. So you can actually customize that to show what putting more money in later does. But once again, it'll illustrate it. It's up to the client to call in and make that change if they wish to do so. This is a very beneficial tool when you're having annual policy reviews with your clients, and saying, hey, remember, a few years ago we talked about you paying in more into that index universal life. Has your income changed? You want to start putting in more money? You can have that conversation with them. And obviously when you're having those conversations, that's also a good time to ask for that repeat and referral business. So here we're just going to leave it this way. The next part is indexed accounts. So like I mentioned before, our system defaults 100% to the global index. This one has the 13.25% cap rate, but you can set this up however you want. Just this total amount has to equal 100,000. So you can diversify this. You can put 50% here, 50% into the balanced uncapped account, whatever you want to do. Other than these two accounts, it's going to illustrate at the same rate. So for the purpose of illustration, if you're going to keep it within one of these three, it doesn't really matter. This becomes important when you actually submit it. And your submittal needs to match the illustration. So if you know that you're going to put 100% into the uncapped, and that's how you're going to submit it, make sure that you do that, because these illustrations have to be signed and they have to match your application. So we'll go ahead and put it there. Income and targeting. If you're going to show income, so you can put in a monthly or annual mode. Generally, we recommend withdrawing from basis than cash. So basically, when you're showing income later, it'll draw from the premiums that they've paid in, and then it'll turn it to a loan, which is they're not paying taxes on, and so you're getting you're not taxed on the income that you're taking. But if you want to show income, you can either put in a dollar amount of like annual income that you want to show or monthly income, or you can just have our system solve for it. And then you can also pick what ages you want to show that income starting. So like if you want to show it at age 71 or whatever, you can show all that here. Target cash value, this is basically the value that you're going to run that account down to once they start taking income. And what age, most of the time, this is done through age like 101 in most cases. For the purposes of illustration, doesn't really matter, but you can change that. So the important thing here is riders. So you have a lot of available riders. The system comes with terminal illness rider. All of our products come with a terminal illness rider. Chronic and critical, you have to select. Couple reasons you have to select them. One, if they are table D, or sorry, E or lower, table D is the last, but if they're E or lower, they don't qualify. There are certain medical conditions that will not qualify them for living benefits. But if you don't select them on your application and on the illustration, they won't get them, and they are free. So get in the habit, if you think your client's going to qualify for them, of selecting both of those. Now, long-term care. So chronic and long-term care pay out very similar. Chronic, though, will give you 2% per month or 24% annually of what your death benefit is. Long-term care will pay out to 4%. So you can actually get more value out of long-term care. But if you select long-term care, it overrides chronic. So you can't have both. So if you're going to sell long-term care, one, make sure that you're licensed for it. Not all agents are, so make sure that you're licensed with Transamerica to sell long-term care. But if you're going to select it, you have to remove chronic. You can't keep critical in there. Concierge planning rider. This is probably not going to pertain to this case, but concierge planning rider is an EVEREST planning rider that provides funeral services on the event of the insured's death. So they come in, they help with funeral arrangements. They can shop different funeral homes to try to get costs down, and on average they save about 13 to 14% on funeral costs. But it's for face amounts of 250,000 or higher. So we're going to run this, and it's going to kick it out, because my guess would be it's going to run less than 250 face amount. Accidental deaths. So you can add accidental death here. It's up to 3 times the face amount, but it caps at 300,000. So 300,000 is the maximum accidental death that you can have. Base insured rider. This is good for people under the age of 50. Oh wait, no, sorry. That's guaranteed insurability. So this allows for face amount increases at age intervals up to age 50 without additional underwriting. Base insured rider is a term rider. So if you wanted to add term along with your index universal life, so if they wanted to have like $100,000, IUL that's building cash value, but they need an additional 200,000 for additional mortgage protection, you can actually do that. You can put 200,000 for up to, so they're 34 now. So if you wanted to do 20 years, you would do it to age 54, and that would give you a 20-year term attached to your IUL without writing a separate policy. Child rider. This is the only rider that you can add after a policy is in force. So if you have a young couple, they don't have kids now, but they have kids in the future, you can, when you're doing your annual policy reviews, they're like, hey, we had a child, you can add a child to these policies. Other key feature here is if, let's say they have 2 kids now, when you sign the policy, they have another kid, you have to add the other kid to the policy. Otherwise, they're not going to have additional coverage. So make sure when you're doing those policy reviews that if there's a change, that you're adding this this feature to it. What's nice, and this is also a term, let's say it changes the payment $12 a month, or the cost of insurance, like $12 a month to add a child. They can add it to 9 kids and it's the same $12 a month. So it's not $12 per kid, it's $12 across the board. And you could, and that cost is depending on how many units you do. Each unit is 1,000 of coverage. You can do up to 99 units. Most common is 25, but they stay on the policy till age 25 and then they drop off, and they are convertible off. The children are convertible off of that child rider for conversion to whole life, not to an index universal life, but they can convert to whole life. Waiver riders. So you've got disability waiver of monthly deductions. So this basically waives the insurance costs and fees associated with the policy. We do not contribute to their cash account, though. It just waives the insurance costs. Last thing here, and this can be confusing, income protection option. So what this sounds like to most agents, because you'll see it on our term product, you'll see it on our index universal life product. It sounds like that we're providing income in the event that they get disabled. That is not what this is. This has to do with how the beneficiary would be paid. So it's more, I guess the best way to describe it is that it is like a poor man's trust. So let's say you have $1 million death benefit, that let's say you have like an 18 or 19-year-old beneficiary. Don't necessarily want to give that much money to an 18 or 19-year-old without some safeguards. So what it does is you can set up the income protection option. What it does is it pays a lump sum at the beginning. It pays monthly premium or monthly payments to that individual for a certain number of years, 10, 15, 20 years, and then a lump sum at the end. So ultimately that whole $1 million is paid out, but it's just not given to them in a lump sum. I see maybe 1 or 2 cases a year where an agent actually uses this feature. Most people have a trust set up for that reason. The other thing that's a little bit tough with this, with the trust, if there's like an emergency situation, or they get more money during college years, you can fine tune a trust far more than you can this. This pays out exactly how it was set up, and they would struggle to pull additional funds in the case of emergency, but it is an available option. And then obviously the long-term care. So last thing here is output design. So what's nice, I don't know why we have this bank option feature, but I've never used it, but you can customize your illustration depend on the type of client that you're speaking with. So if you're dealing with a business professional, or you're dealing, a family, there's family photos, maybe people who are outdoorsy, or just, we have obviously Transamerica logos. You can customize the front page of your illustration to kind of reflect the type of client you're speaking with. Our system defaults to a bike for some reason. So why Transamerica? This just talks about us as a company. It goes over our ratings and how much business we do. So if people aren't familiar with Transamerica, it's a good thing to show. Snapshot, it's a better policy details. These two, actually these 3 are kind of up to you. So you have a cost and values ledger, which breaks down the costs and fees associated with your illustration. Non-guaranteed current projections, which just shows everything at that 0.75 rate, which it does anyway. And then internal rate of return. most agents don't get into this much detail with clients, but you do have that option. Like if you're dealing with somebody that's really savvy, they might want to know, like, the cost of value side of it, the internal rate of return, all of that. Purchase accumulation strategy. This is good if you're like a CFP and you are comparing this to like an IRA or somebody trying to self-fund like a savings account or anything like that. So you can customize like what an IUL looks like versus one of those strategies. The last thing here is input summary, and I'll show you what that is once we run the illustration. So once we have all this information in, I just hit calculate. Sorry, I have to make one change here. I forgot when we do a target solve, it won't let me do optimal switch. So I'm just going to do increasing and then hit calculate. So cover page. So this target solve, because it took our $200 and it tried to maximize the death benefit based on the $200 a month based on their age. So the upside is this is essentially the number that you guys get paid off as this target premium. Now I'm not on the commission side, so I don't know what percentage or any of that you get. I just know that it's based on this number. But long term, it's probably not the best for the client. That's why I was mentioning if you're going to do like minimum non-MEC, which is the most beneficial, versus target, which gets you paid the most, trying to find a balance between those. But here it shows your first policy details. You've got the allocation, however you have it set up, basic client information, any riders that you had. Once again, why Transamerica, kind of goes into all that. But the more important pages come down where it shows the different account options. It goes into details about what they are, your participation rates, caps, floors, index account charges, and then the max illustrated rates. So everything that we kind of went over. But this is really what most clients want to see. These are your projection pages. So you have 3 different columns here. This is guaranteed projections, non-guaranteed at 3.5, and non-guaranteed current projections at 7.25. So this column is our maximum illustrated rate, which our product still performs better than that number. But this is kind of where you can see your cash growth over time. This one is based on the current rate of the basic interest account. So if they just put the money in the basic interest account, this is what it would do over time. This guaranteed projections, 0.75. People kind of focus on this a lot. Well, this is the only guarantee. This is the guaranteed projection. If this situation happens to where you're at the floor every year, it means the market's either at floor or negative. If this situation is happening, World War III happened, because this is basically saying that the market is down every year. And so all the money they're throwing in that is really only going to keep this policy alive until age 67, 68, and it's never going to have any cash growth. So this is the only guarantee. But like I said, if this is happening, things globally are not great. So ultimately, this policy lapses because at $200 a month, you're kind of over time, this is going to cost too much to keep in force, but the policy still runs to age 99. So one thing I just will look at here from a cash growth perspective. So at age 65, year 31, you have a policy value of $138.77 based on this $253,000 face amount. Even though the death benefit is an increase because of the policy value, because it's adding your policy value and that 253 to come up with your death benefit. But if I make one change to, like I said, this is what benefits the client the most. If I go to minimum non-MEC, so it's taking their $200 a month, it's going to lower the death benefit. Optimal switch will work here, so I'm going to calculate this out. The optimal switch always takes a little bit longer. So it's recommended to run this policy level in all years. It drops the face amount all the way down to 100,000. But now when I look at that cash growth, policy doesn't lapse. But at age 65, I've got more money, death benefits growing. policy doesn't lapse. Obviously, the longer they live, the better cash, the more cash they have. They've stopped paying because remember we showed that we're going to stop paying at age 70. So they've stopped paying here. Policy still grows. So the longer they live, the more they're leaving for their heirs. And obviously, you can play with all the numbers. You know, if you've got somebody that says, I want a $150,000 face amount and $200 a month, you can control both numbers and then just hit calculate. It's going to rerun the numbers based on that. And you'll notice that target premium went down to 951. So here, trying to find a balance between that 250 and that 100, raise it up a little bit. You guys get paid a little bit more. Policy still has great cash growth over time. And this is more of a win-win for both parties. There are certain groups that just run everything at target. You'll notice if you do that, your cash surrender value generally are 0 within the first 2 to 3 years because it's struggling to build cash value early, just doing complete target solves. But this is your guys' paycheck, so obviously and you know your client, so obviously work it the way that you think is going to be the best. So if last thing I'll show here, because I ran a little bit longer than I thought I would. If you want to send this to a client, there's a Save Enables e-signature. It creates a downloadable PDF that you can send to your client. The other thing that you can do here is I can go to cases. I can do a save as. If you guys, and then if you do save as, and it'll save case down here. What's nice is you guys can, if you're building this, you're like, I don't know if I did this right, or you want to get a second opinion on this, you want to call into the sales department. If you save that case, I can look at it on my side and be like, oh, I see what you did here. Let's make this change or that change. And we can kind of help give you guidance on that. And to make sure that you're obviously maximizing what you guys want to do and what the client's needs are, so we can assist with that if like I said, if you do this save as feature. And this is also like if you just wanted to be able to come back to this case later, it'll save it under your open cases. Yes, so you'll have all these open cases here, and then you can always come back and refer to them. If you wanted to come back and make changes to a case later, you can do so. So I'll kind of wrap it up there and just kind of open it up to any questions that you guys have about the product or about the, the software or anything that you have. And I can send links to, well, if you go to this Insurance Central, just so you know, products, Index Universal Life. Like I said, this is on your whole homepage. So you have agent resources, there's videos, flyers, and then all of agent resources are all in here as well. And this is all in your Insurance Central stuff, but I can send these out if you need.
Yes, please do.
Okay.
I have a question. When you asked about the client's hobbies, right? What if they have a motorcycle? Would you need to list that?
If they're racing the motorcycle, yes.
No, they're not racing. They just have one.
Yeah,
okay.
So you're fine there. Yeah, but if they're taking it on a track, and laying it on its side,
right,
defying gravity, yes, then that's an issue. It's mostly personal pilots, people that aren't like commercial pilots, skydivers, rock climbers are another big one. Jobs I've seen recently are like bridge workers, people who build like high rises, things like that, people that are off the ground a ways. Those are the most like common jobs that we see. But driving record is probably the most common. If you get people that have multiple tickets, maybe multiple DUIs in their past, they're past that limit where we would decline them, but they still have a history of it. Sometimes we'll put a flat extra on there. So, but that's the most common thing we see. And normally it comes up after the fact, because we run MVR on most people, depending on their age. But when we run motor vehicle, it's like, oh yeah, they have an issue here. But that's the most common times that we see flat extras.
Okay, I have okay, so that was one question. So I had a person, I wrote an application on the IUL and it came back declined because it said his criminal history. So my question is, would he not be able to qualify for any Transamerica product?
So there's a lot of caveats to that. One is time. Normally on felonies, it's 10 years.
Yeah, I know he doesn't have it. Well, let me say, I don't know anything because I asked him, did he have any? He said no. So it's something on there.
Yeah, there's something flagging. So normally it's 10 years on felonies. There are certain felonies that we will not, depending on what they are, that we won't cover.
Okay.
Mostly against like children, things like that. Like, no, we're not going to give you insurance.
Right.
The other big thing is, and where there's a lot of confusion in the market on it. So it's not, let's say they got convicted 10 years ago. All right, that's not what we're counting. We're counting from the time all of their obligations are met. They finished probation, parole, like they finished all their obligations related to that. That gap has to be 10 years. So it's not, yeah, they got convicted 10 years. They spent 2 years in jail and they were on probation for another 2 years. That's 6 years to us.
Right. Okay.
Okay. So it's there has to be at least that 10-year gap.
Okay. Okay. Thank you.
You have some in a comment too, Jason.
Oh, I do. Hang on. I don't know if I can see comments. Can I see comments? Oh, there we go. Motorcycles. So the IUL start at 100,000 if you're using a preferred risk class. If you're doing standard, you can go down to 25,000, or if they're a juvenile, you can do down to 25,000. Like that particular one that I just ran, I used a preferred risk class. So even though I did a minimum non-mech, the minimum is going to let me do is 100,000 because of that. If I move to a standard, it'll probably give me a lower face amount. Client can do, well, so grandchildren, no. Client, so the deposit on a lump sum, you can, yes and no. You can do it at the beginning. You can do it in a year, but on any, did I close this? Let me see if I closed. I did close it. Oh wait, no, here it is. So you have a 7-pay premium number. So this is pretty much the most you can put in any single year. So like this particular policy, they're putting in $2,400 a year. You can put in up to this amount. As long as they don't exceed that amount, it's not going to flag it as a mech. So yes, you can put more money in. You don't want to exceed that 7-pay premium number. So there's more flexibility for them to put more money in this policy. But the key is just don't exceed that 7-pay premium amount. And when you do that, so that would be key. Hang on. Client, let's see, does the IUL go to 0 at age 99? If you can set it up to do it that way, most of them, they're designed to just continue to grow till age 121, unless you are income solving down to age 99, then yes, you can get it to 0 at age 99. Client on dialysis, you might get a table rating on an IUL. That might be declined. I can tell you that we do standard on our immediate solutions final expense if they are on dialysis. You can do policy loans after the first year, as long as there's cash value. So after the first policy, so, and there's two different loans. There's premium loans or there's standard loans and preferred loans. Standard loans are years 1 through 9, so just a little bit higher rate. Year 10, you go to a preferred loan. It's like a quarter or half a point less on interest on the loan on policy loans, but you can take policy loans after the first year. Is that it? Any other questions?
So so it's 4% for the long-term care rider. If you add that on there, could you go over that just one last time, the long-term care rider, or in the funeral
It's
concierge product too?
yep. So long-term care, it's really the payout. So either way, the money's coming out of your whatever money you have built into your index. Obviously, the more money the more you can pull. But with with chronic, it's 2%. So you'll allow 2% per month up to 24% annually. Whereas long-term care, it's giving you an extra 2%. So it's gonna allow for more, like if you have higher costs, it's gonna help offset that a little bit more. And that long-term care comes in handy so that you're not trying to liquidate other assets. Like whether it's retirement accounts or if you're having to like sell things to cover these medical expenses. I mean, it's really designed for, to take the money out of the policy and use it. And obviously the more money you have built into it, the more that you can pull from it later. One of the things that we see a lot of, because there are certain states now that require long-term care, otherwise you pay a higher tax rate for the state, like Oregon. So like these people are required to have some kind of long-term care. And so we have a lot of agents that will call and say, yeah, I got a 55-year-old and we want to do long-term care. If they need, if something happens to them in the next 10 to 15 years, there's not really going to be a lot of money for them to pull from in those situations. I mean, it's great if somebody's younger and they've built up that account, but somebody trying to start an IUL in their, late 50s, 60s and try to fund enough money to where there's money for long-term care, that's going to be a tough go. Because one of the things with IULs, and I'm sure you guys are seeing this, is the be your own bank. That's the thing out in the market. What I would caution against that is what they're failing to explain, and what they make it sound like is, I got $1 million IUL, therefore I have access to $1 million. You don't. You have $1 million death benefit, and you have to put money into the account. It has to grow for you to borrow against it. And if you minimally fund it or you don't overfund it, that money's just not going to be there. But the perception is, I got $1 million policy, therefore I have $1 million. That's not the case. So, the money has to be there. Like I said, where we see like older clients utilizing an IUL. So like most term policies are going to end mid to late 80s, if depending on when they started them. But most of the time, that term's going to expire sometime in their mid to late 80s. So somebody might minimally fund an IUL to keep a death benefit afloat to like 95 or 100. So they're not trying to use it for cash growth, but they know, hey, people in my family live to 100. I want to make sure I have death benefit for, longer than what term might afford me. So we'll have a lot of people utilize an IUL for that when they're older. Because unless they're just going to throw a bunch of money in it and they want to get cash growth out of it, most people will minimally fund something when they're older for that purpose. But does that answer your question? And then you had another question. I'm sorry. What was the other question that you asked about?
Oh, was the funeral concierge service. And
yeah. So this concierge service is only on 2 products. It's on the Financial Foundation Index Universal Life. We've been told that they're trying to add it to the Financial Choice IUL. They've been saying that since it came out 2 years ago. I don't know when it's coming, if it is, but it's on our Final Expense Express, and it face amounts over $250,000 on the Financial Foundation. So if client dies, they can call EVEREST. They have certified funeral planners that work for them. They work with the family to, to make funeral arrangements, burial arrangements, coffins, urns, like all, anything associated with that. They also have like sub features that not a lot of people know about. That company will do will prep. So they'll do like a small will for them just to make sure that certain assets are covered. They also do digital document storage. So if they have key financial documents that they want digitally stored, Everest will do that for them as well. I'd have to check. So one of the aspects on the Final Expense Express, and I don't know if it carries to the Financial Foundation, I think that it does, but I'm not 100% positive, is they have normally to get access to the death benefit, you have to have a death certificate. And sometimes that can take some time. On the Express side, if once the body makes it to the funeral home, they can release up to $25,000 worth of funds within 3 days. So without a death certificate. So that gives, the family a little bit of jump on covering those funeral expenses without having yet full access to, to that death benefit. I think it's the same. I can circle back around with you on that and figure out. And then I have flyers on it. I'll send the flyers out, but I haven't looked that closely on the aspect of the Financial Foundation Index Universal Life to see if it's the exact same. Other question I see here: what is the difference between FFIUL choice, which is better for long-term care versus policy loan? So Financial Choice doesn't have long-term care on it. It's only on the Financial Foundation. That's the only place we offer long-term care is on the Financial Foundation. The FFIUL has more indexed options. So there's a global plus, there's a global index, global plus, S&P plus, S&P. There's the small mid fidelity account, and then there's the balanced uncapped account, and there's a basic interest account. So there's a lot more versatility in that product. The cap rates on the global plus account are as high as 15.5%, but you still also have that balanced uncapped account. Where the Financial Choice is different is, one, you have a minimum face amount of 250,000. So you're starting at a higher low end on that product. It's most people who are doing the Financial Choice are doing 7 pay or 10 pay. They're trying to throw as much cash as they can in early and often to turn it into cash growth faster. That product earns better early than it would long term, whereas Financial Foundation is really good long term. So that's where we see most people utilizing the FFIUL. There's also a persistency credit that's part of the FFIUL. So after year 11, they get an extra 0.4% just for being in the product. It does have a 0.25 floor, so it doesn't have the same 0.75 floor, but you get to year 11, that 0.4 kicks in. Now you have a 0.65 floor. Chronic illness is free. Long-term care does have a premium. And it really depends on the size of the face amount, the premium. So there's not like a fixed amount on it. But if you wanted to see that played out, if you do on the case design, if you do this cost and values ledger, and you'll see that the costs and that associated out. But chronic is free, critical is free, terminal is free. It's built into the product. On term, because on term we have 2 term products. You have Trendsetter Super, Trendsetter LB. The Trendsetter Super has terminal illness rider. LB, you're paying a higher premium, but it's adding chronic and critical to that. But both of our IULs, it's built in, and our lifetime whole life product also has those riders built in. But same thing, you have to select them. So just I can't stress it enough. I select them. If you're running a quote, make sure you select them. Make sure you select them as part of the policy.
And last thing, Jason, the income protection option, that rider and a children's rider that you can add on later on in time. Could you go over when's the best time people could add that into the FFIUL?
So the income protection has to be done at the beginning. And like I said, that really only comes into play. That's how the beneficiary is paid out. Like I said, most people have a trust set up for those situations. Like 1 or 2 cases a year do I see somebody actually do income protection. Most people have a trust for that, but it has to be set up at time of when the policy is written. As far as child riders, if they have children now, put the children on there now. And like I said, you can have the most common amount of coverage is 25 units or $25,000. So if the child dies, the parents get $25,000 per child. but it can be added at any point. So once that kid is 15 days old, so if somebody has a baby, wait 15 days and then you can add them. Generally, you need a social security number to add them. Sometimes that can take longer. But if somebody has a child, I would add it as soon as possible. And if they have additional children, like I said, they just have to add the name of the child and the social security. There's not going to be any additional costs associated with adding an additional child up to 9. They can have up to 9 kids, and it's the policy, the cost on it won't change. And like I said, these are all like, if most agents, I think where they rise or fall is really on that annual policy review. Surprisingly, most agents don't do them, and you're missing out on crucial information, changes in their family, maybe changes in income. They, somebody that couldn't afford whole life or some more permanent coverage a year ago probably can now, but if you don't reach out to them, you'll never know. Adding those children for protection is key. Making sure that their families are protected. They buy a bigger house, have a bigger mortgage, need more protection. Like all of those are key, information that unfortunately that, like I said, we see, because we cover a lot of, mortgage brokers. Where they fail is like, oh, I'm just going to write as many policies as I can. And, if I talk to them again in the future, great, but it's that follow up annually and making sure that their needs are met, with their changing lives that most agents will kind of rise or fall. And so, an IUL is a great way to keep in front of those clients, especially if you know that they're going to make policy changes, if they want to increase how much money they're putting in, and if they're really earning and they're maximizing the potential of those, it's a great source of referral business. Who else do you know that could benefit from a product like this that wants to supplement their retirement income, wants tax-free retirement income, so it's a great source for that. So
Well, I would say thank you so much, Jason. I know that we have your information. We can get back up with you. I know it's the top of the hour, and I really appreciate that. I know some agents are going to want to do some 30 minutes or some one-on-ones with you or some case designs with you. So I'm sure they are. So I have that information. I'm not going to put it out there publicly, but I know they'll be getting back to you. I just want to thank you for even going the extra mile and really
yeah.
explaining this to us. You did a very good job. And man, thanks so much, man. I know we'll be talking again in the future.
Yeah, and like I said, if you guys need anything, and if even if it's not Index Universal Life related, if you have questions about any of our products, like I said, we did make changes to the IUL. The big thing lately has been our Final Expense Express, which is 100% digital, 100% instant decision, and you guys are getting on average, I think, 10 to 15% higher commissionable rates over our existing Final Expense product. So, definitely utilize that. And if you have any questions about it, it's great. So.
Yeah, they will be. A lot of it's about the FE Express. So
Yeah.
We're very excited. We're writing a lot of that business right now. It makes sense. The funeral concierge, component is awesome with the will, live and will, power of attorney, will prep, all of that. It's just hands down the best final expense product. The term, I love it. I love you guys IUL, what you guys are doing with the FFIUL II. Hey, and I can't wait for the instant decision IUL and term coming out. That's the main thing,
Yeah.
Let's get the approval done first, Jason, and then let's get in the case design. I would love that,
Yeah. So I know that the success of those two products, or the us releasing those, completely revolve around us working through some current issues that we're having on the Express. Most of the issues on the Express, honestly, are just not everybody has their licenses on file for all the states that they have. So that's taken some time. We've signed up with a company that will automatically pull that information, and I don't think that starts for another month. But I think once we have all that information and we've worked through any kind of underwriting, issues or hiccups through the Express, then they'll move it to term, and then they'll move it to IUL. And so, so yeah, we look forward to that in the future, but I know that term is the next step. And I know that they've been in talks with the same software company on the term side. So I know that's the next step, but as long as those launches go well, then, IULs are on the corner for sure.
Awesome. Thank you so much, Jason. I appreciate it so much. Thanks, guys, for jumping on. Hopefully, we see you guys next Saturday down in the DMV. We'll have Scott Grode there doing a IUL, training for us and FE Express training for us, and this will be awesome. So, thanks a lot, guys. Thanks, Jason.
Thank
See
you.
guys next time.
Appreciate you.
Thank you.
Right. Bye-bye.
Thank you. Bye.
All right, Will. In Georgia.
Oh yeah, got to get with you too, Jeff.
Yeah, listen. Can you have that little class that you gotta have that you're gonna do Monday? Can that be sooner than Monday? I'm ready to get to rock and roll.
I think I might have a recording for you already, so let me find it and I'll send it to you. That's about the leads, the IUL leads, final expense leads, all that. Yeah. So let me find that and get that over to you so you can watch it. I think it was one in the video I sent you. But let me find the one we did 2 weeks ago and get that to you. If not, we're going to keep doing it. If not, we can do a one-on-one or something, and I can show you how to do it.
Okay.
First, let me register you. Let me get you in the lead system, the lead center.
Okay. Do you recommend ordering like flyers and stuff?
Yeah, you can order Transamerica flyers and all that stuff too. But it's the pre-approach letter, the actual lead, that you're sending back out,
Okay.
That's what you need. And predatory life insurance list, those 3 letters you send out to old leads and they open them up, and that's kind of how you want to do it.
All right. Well, I'm gonna follow your guidance because everybody else stuff ain't working.
Yeah, that's the best way, because nobody else has this product, FE Express either. So you want to pitch them this product, and doesn't matter if it's Maryland, DC, Virginia, or Mississippi, or Tennessee. Nobody has this product. It just came out in September.
Is it available in Texas also?
Yeah, yeah. We have people writing it in Texas. Yep.
Okay, good. All right. Well, just send it to me and I'll be ready. Thank you, man.
All right.
All
Thanks
right.
so much.
All right, bye.
Bye.